Okay, so let's get right into it. Have you ever looked around and wondered, how is it that some people seem to pay way less in taxes, even though they're making a ton more money? Well, that's exactly what we're going to deconstruct today. We're going to pull back the curtain on the tax code and show you the core ideas that make it all work. So let's start with maybe the most important question you could ask about taxes. Is all income tax the same? Now, your first instinct might be to say yes, but the answer is a hard no. And really, understanding why is the secret to unlocking this whole system. And here's the thing you've got to understand right from the get-go. The tax code, it's not just about the government collecting money. Not at all. Think of it more like a giant rule book designed to get people to do certain things the government thinks are good for the economy. Like owning a business, investing, or providing housing. It's basically a system of carrots, rewarding you for playing the game a certain way. All right, here's our game plan. We're going to start with the two different tax systems. Then we'll look at the huge gap between income and tax rates. After that, we'll open up the deduction toolkit, get into the power of paper losses, figure out how to navigate the rules, and wrap it all up with a generational wealth loop. Let's do this. First up, the two tax systems. This is where we break down the fundamental split, and I mean the biggest split there is, between how money you earn from labor is treated versus money you earn from your capital. Honestly, if you get this one concept, you're halfway there. So what's really fascinating is that this creates two totally separate tracks. On one side, you've got income from your labor, the money you get from your job, your W-2, or from your own small business. This stuff gets taxed at the higher ordinary income rates. Plus, it gets slammed with payroll taxes. But then you've got this other track, income from capital. This is the money you make from your assets, stocks, real estate, you name it. And this income, it's taxed at way lower capital gains rates, and, this is huge, it dodges those payroll taxes completely. It's like two different games with two very different scoreboards. Okay, on to our next section, the income and tax divide. Let's put some real numbers to this, because seeing the actual difference between ordinary income taxes and long-term capital gains taxes, well, that's what drives pretty much all tax strategy. And bam, there it is. Look at that difference. For 2025, the highest federal tax rate you can pay on your regular income is 37%. But for long-term capital gains, that's profit you make on an asset you've held for over a year, the top rate is just 20%. That is a 17-point gap. This one chart explains basically everything about why the wealthy focus so much on generating capital gains instead of a salary. All right, section 3, the deduction toolkit. Now we're going to look at the main tools that pretty much everyone can use to shrink their taxable income. It doesn't matter how you make your money, this is always the first move in cutting your tax bill. So, every single taxpayer has to make this choice. On the one hand, you have the standard deduction. Just think of it like a freebie the government gives you, no proof required. For 2025, it's 15 grand for a single person. It's super simple, which is why most people take it. On the other hand, you can itemize. This is where you track and add up a whole bunch of specific expenses. You'd only go this route if your total is more than that standard amount. So the choice is pretty clear: simplicity or a bigger tax break if you're willing to do the work. And these are some of the most popular tools in that itemized toolkit. We're talking about things like contributions to your 401k or IRA, or to a health savings account, which is amazing, by the way. Then you've got mortgage interest, your state and local taxes, though that one's capped at 10 grand, donations to charity, and even interest on your student loans. Each one of these is an incentive, right? The government is encouraging you to save, to buy a home, and to give back. All right, now for section 4. And this is where the game really changes. We're talking about the power of paper losses. We're about to unlock the single most powerful deduction out there for investors, the magic of non-cash expenses. The secret weapon here is something called depreciation. See, the tax code lets you claim an expense for the wear and tear on an investment property over many years. But here's the kicker. It's a non-cash expense. You get to write off a loss on paper even if you didn't actually spend any money that year. It's wild. Okay, let's make this real with an example. Imagine an investor buys a rental property and just the building, forget the land for a second, is worth $1 million.
So based on the rules for residential real estate, that $1 million building allows for a deduction of about $36,000 every single year. And you can take that deduction even if the property's actual value is skyrocketing.
And this is how you create what's called a paper loss. So the investor could be collecting rent and making a real profit every month, but on their tax return, they can actually show a loss because of that depreciation. That's the whole strategy right there. Creating a tax loss on an asset that's actually making you money. So that brings us to section 5, navigating the rules. Because of course, the government put some guardrails on a powerful tool like depreciation. But as you're about to see, the rules also give you a playbook for how to get around those limits and use these paper losses to reduce your other income. Right, so here's the wall the IRS puts up by default. It's called the Passive Activity Loss Rule, or PAL. And what it does is it says you can't use losses from a passive investment like a rental property to cancel out your active income, like the salary from your job. They try to keep those two worlds separate. So how do you break down that wall? Well, the IRS basically gives you two keys. On the left, you have what's called real estate professional status. Now, this is for people who are, really deep in the real estate game. It's their main gig. If you meet the criteria, boom, all your real estate losses can wipe out your other income. But what about everyone else? Well, that's the key on the right, the short-term rental strategy. If you're renting out a place where the average stay is short, think 7 days or less, and you're actively involved in managing it, the IRS says, okay, that's not passive anymore. And just like that, you can use those paper losses to lower your regular taxable income. And that leads us to our final section, where all these pieces come together in the ultimate wealth-building strategy, the generational wealth loop. This is really the peak of tax planning, where you combine asset growth, debt, and estate planning to legally eliminate taxes. It's a 3-step dance often called buy, borrow, die. It's a masterclass in using the tax code to your advantage. Step 1, buy. You get your hands on assets that are going to grow in value, like stocks or real estate. Step 2, borrow. You need cash, but instead of selling, you just borrow against those assets. Step 3, die. And then you pass those assets on to your heirs, and a little bit of tax magic happens. This quote right here is the engine behind the borrow step. Money you get from a loan isn't considered income. Why not? Because you have to pay it back. This is so powerful because it lets you tap into the value of your growing assets for years, decades even, without ever having to sell and trigger a big tax bill. And this is the grand finale. It's called the step up in basis. When you pass away and your kids inherit your assets, the IRS basically hits a reset button. They pretend your heirs bought those assets for whatever they were worth on the day you died. What does that mean? It means all the capital gains, all that appreciation that happened over your entire lifetime, it's just gone, wiped clean. A lifetime of growth becomes completely tax-free for the next generation. So when you boil it all down, what we've seen is that the tax code isn't this single monolithic thing. It's actually a complex game with different rule books for different players. And that really leaves us with one big question to think about. The tax code is a set of rules. So which set are you playing by?